Buenos días. Good morning. Who's there? Is it just me? So I promised, hi Daviana. I promised that I would just take a step back because my connection broke when I was explaining this slide. So it was not very clear. So as I explained last class, the test on the weekend will be everything up until the new material, and then the final will include the new material. But what I'm going to do to incentivize people to study the new material is have an optional question for the new material in the test. So that way you don't waste time studying for it. I don't want any waste of time. We have no time to spare, right? Okay. Any questions for me right now? Okay, so let's get back to this one. All right, so the discussion topic was capital structure. Capital structure is the composition of debt and equity in the firm's balance sheet. And we answered the first question very clearly that management is aiming at maximizing. Well, actually, no, this is the one that I got cut off, but I did explain, but I will explain again, that management, that the final exam is cumulative. It's everything. The test, you'll see that it includes since the last test, the material since the last test. I just said that I will add an optional question on the new material for people who do work ahead, and not to waste their time, to reward them for working ahead. All right, so I began discussing, should management aim at maximizing the entire pie or just the equity of shareholder equity? Because shareholders ultimately are the owners of the firm, and they will vote in, they will continue to support a board of directors that hires management that gives them profits, right? That shares profits with them and increases. And then the question is, do they care about just that, or do they care about the value of the firm? So I provided an example to illustrate in very simple terms that they are tied. The shareholders should be concerned with firm value. And the illustration went like this. We begin with an unlevered firm. That's the U for unlevered. It means an all equity firm. Its current value is $1,000 with no debt, and since it's only equity on all equity firm, the stockholder equity is equivalent to the $1,000 value. I've included here that there are 100 shares, so the stock price is $10 a share because 10 times 100 makes 1,000. Now, the firm is looking at a debt issue, so they're going to issue $500 worth of debt, and with the proceeds, so they're borrowing that money, by taking on those bondholders, they will just have $500 that then they just turn around and distribute as a $5 dividend to each share. So this is because shareholders, just looking at the possibility here, I'm directly benefiting shareholders with the issue to take on debt. We're going to talk about why they would do that after I get through this, but right now I want to demonstrate to you that shareholder equity is indirectly tied to the firm value. So this is how I'm going to look at it. I don't know what's going to happen because of this. This could be perceived as good. This could be perceived as bad. This could adversely affect returns to shareholders in the future. So what I've outlined are three possibilities. It could turn out that things go great and the value of the firm increases. So this stands for L. L stands for the levered firm. So this is the value of the new of the firm with debt. Now it went up from 1,000 to 1,250. What does that mean in terms of shareholder equity? Well, shareholder equity did go down. So I figured that out by knowing that V equals B plus S. So I could solve for shareholder equity in the new or the levered firm. So does the story end there? No, because shareholder equity is just a part of payoffs to shareholders. Remember, I'm going to distribute that $5 dividend to each share. So in total, that's $500 that goes to shareholders. Now there's a capital gain loss by the issue because shareholders' value went from 1,000 to 750. So I mark that as capital gain or the capital loss. And but then it's offset. That is offset by the dividends received. So the payoff is positive to shareholders of this restructuring. So that might happen. What if nothing changes? So how could nothing change? Well, I'm just going to propose that there's no change in the firm value after it issues debt. As a result, we could calculate shareholder equity. It's gone down to 500 from 1,000. So that is a loss, capital loss of $500. Put that together with the 500 total in dividends, then there's no net payout. There's no effect of the restructure. And the third scenario, in the worst case scenario, let's say the firm loses value, that would leave the shareholder equity as 250. The debt is 500. Then what happens is we have to consider the capital loss of 750 as the value of stock went from 1,000 to 250. Offset that is not it's not enough. The dividends received are not enough, so there's a negative payout or a loss. So what you have here is what I've demonstrated after telling the story, that the firm's value and the payout to shareholders is correlated. Firm value is up, shareholder payoff is positive. Firm value doesn't change, there's no extra payout to shareholders. The firm loses value, the payout is a negative to shareholders. So these are intimately tied. So in fact, shareholders do care about the value of the firm. It does indirectly affect them. So we see when the value of the firm is high, so is the value of shareholders. When the value of the firm is low, well, shareholders lose value. They have negative payoff. So shareholders should be concerned with the firm's value. So that is the conclusion, or that is the answer to the first question. I hope that's better explained, or at least by demonstrating what I'm talking about, helps you understand better. All right, so now we're going to answer the second question. So if the value of the firm matters, then we care about debt, then what is the relative, what should be the debt to equity ratio? So relatively speaking, what's the optimal debt to equity ratio that will maximize the value of the firm and in turn maximize shareholder equity? How can we figure that out? So it's a very complex question that was tackled by several financial economists, and Modigliani and Miller framed their answer, their response to the question, by beginning with a very abstract scenario, several assumptions in it, where it doesn't matter, where the firm value is not affected by financial leverage. Okay, so here we have the levered firm has the same value as the unlevered firm. So I guess it's kind of going with this scenario, and it produces that scenario with several assumptions. It's the only way to get that result. This is known as Modigliani and Miller's Proposition 1, and I do believe they won a Nobel Prize for this work. So they begin eliminating the incentive to having debt or taking on creditors. They remove taxes. So why is that? Why does that have that effect? Well, because it's interest payments to bondholders that is tax deductible. Well, if there are no taxes, then there's no benefit of the tax deduction. So we'll remove that. We'll also remove the chance that a firm, by issuing debt, risks default. So remember, shareholders might view debt issue as problematic because shareholders are residual claimants to the profits of the firm, and the firm is obliged to pay creditors first and preferred stockholders next, and then common stockholders are left waiting, anticipating if they're to get any kind of dividend or realize a payoff. So we are going to say that at some point, even creditors might be concerned about the additional issue of debt because they might anticipate that they won't even be paid. Okay, that's a risk of default. And when creditors are worried about default, this can really create a cascading problem for the shareholders, the owners of the firm. So we're going to remove that completely and deal with that later. We're also going to simplify things and assume that cash flows are perpetual, like we usually do, right? We say that to estimate the value of the firm, we assume all kinds of things. We think about the present value of future cash flows, and we consider what if cash flows, the dividends remain the same out into the future. So we're going to assume that here. We're also going to assume that firms and investors can borrow and lend at the same rate. So that's as much a stretch as all the assumptions are. This is another one, because in fact firms and investors do not have the same rate of borrowing and lending available to them. But we're going to assume that to get the result that we're looking for. And of course, finally, I reiterate that there are no taxes. All right, so here is the lay of the land. Consider two firms identical in every way except that one is levered and the other is all equity. So this is the all equity firm where the value is $1 million, and that's equivalent to shareholder equity, no debt. And then alternatively, there's a firm that's identical in every way except that it's levered. So the leverage, the amount of debt is $400,000, and the yield to maturity that's paid annually is 5%. And I also just don't have any coupons here. Or do I? Let me think. Does it matter? That's the return. Okay, I'm not going to mention that. Uh-oh. This got moved. I'll have to fix that. I'll have to send you an updated one. Didn't realize that was distorted. So we're just going to say the yield to maturity of the debt is 5%, a period. All right. So keep in mind that firms and investors can borrow and lend at the same rate, and there are no taxes. We're going to say, this is another assumption that I've already mentioned, but I want to reiterate that the firm is the same. They're identical in every way. So they both have the same dollar return. Okay, so the firm assets have the same dollar return. So let's consider strategy A. So what we're going to do is look at two scenarios: an investment in the levered firm and investment in the unlevered firm, and whether we can determine that the value of the firm remains the same. So imagine there's an investor in the levered firm and they buy 10% of the outstanding stock. So here's their dollar investment. 10% of outstanding stock in the levered firm is 10% of V minus B in the levered firm. So that works out to this amount. That's their investment. Their dollar return is %10 of, well, this is the Y that I mentioned. This is the dollar return to assets. And then this is the payout interest payments to bondholders, which is a percentage of total investment. Okay, so then I can put some numbers in here. This one was 5, that one was 400,000. And so this is the dollar return. When I simplify it, it's this amount. All right, now let's look at an investment strategy that's essentially, we're going to find out its equivalent in investing in the unlevered firm. So this could be accomplished by buying 10% of the value in the unlevered firm. So that's just 10% of equity. And there's no debt issue in the unlevered firm. However, because borrowing is available to the investor at the same rate as the firm is lending, they're going to borrow 10% of the same amount as the levered firm has issued. Okay, so in so doing, the dollar investment simplifies to this amount. So this is the dollar investment in the unlevered firm. Now this amount, remember, this is just the $400,000, but I'm using this symbol because, well, you'll see. Now what's the dollar return of this strategy? That would be 10% of the total return to assets in dollars, minus they have to pay, right, at 10%, they have to pay at the same rate of 5% that they would have gotten if they invested in the levered firm of the amount that they borrowed, at 10% of the total 400,000. And you simplify this, and it turns out that the dollar return, you can, by doing this, the dollar return in the unlevered firm is equivalent to the dollar return in the levered firm. Now, since the dollar return from A and B is identical, so these are identical, the identical cost of both strategies, the initial cost of both strategies must be identical, since there can be no arbitrage opportunities in an efficient market. Any kind of profit will be bid away. And so we assume that we are operating in efficient markets and there are no opportunities to make profit. So it has to be the case that, now I'm going to rewrite this piece and clean it up, and I apologize that this happened, that I'm just recopying here. Actually, you know what I'm going to do is I'm going to take it over. So though the dollar investment must be identical, and how can that be identical? Think about that while I clean this up. I just wiped it out. These can only be identical if the value of the levered firm is equal to the value of the unlevered firm. Okay? So with no taxes and all those other assumptions, I have found a baseline situation where they will be identical. It doesn't matter if there's equity and debt issued or just an all equity firm. In this setting, firm value will be identical. Okay, so this is known as M&M Proposition 1, no taxes. at the conclusion that, given all those assumptions, the firm value is not affected by leverage. And I can illustrate that. So this illustration will be the beginning of several. I'm going to plot the debt to equity ratio here, and the point is it doesn't matter how much relative debt there is to equity, the value of the firm stays the same. I plot value of the firm on this axis. Now we care about the value of the firm, of course. We just mentioned that the shareholders care about the value of the firm, so it'll determine whether they invest in firms or stay invested in the firm. They care. So from prospective investors' point of view, they care about the value of the firm. That's why we're doing this. And in practice, that's true as well. Value of the firm is important in general for mergers and acquisitions. This is really important to know. What is the value of the firm? So these tools that you're learning are very basic tools in your toolbox for determining how to make those deals. It's selling firms and defending your case. If you're part of selling a firm, if you're part of if you're consulting, or if you're working with a merger, that's what you're doing. You're trying to figure out the value of the firm. All right, so the other side of our analysis has to do with the return to shareholders. I spent some time last class going through all the stakeholders that we're going to consider. And in an unlevered firm, it's just the shareholders that are the owners. But in the levered firm, there are shareholders and bondholders. And they have, and they're shareholders, bondholders, and the average investor. So all these stakeholders need to be considered, and the way we consider their perspective is their required rate of return. So this is their dollar return. Now remember, what the WACC is, right? So WACC is the weighted average cost of capital. So this is the formula for WACC without taxes. Notice there's no taxes, so I took that out. This would usually be like this with a corporate tax rate there, but I take that out. And I just have this weighted average. Now, because of the result that we just learned, WACC must be constant. So here I have the symbol, the return in the unlevered firm, since the value doesn't change. In the levered firm, the WACC for the levered firm, the return to investors in the levered firm, should be the same as the return to investors in the unlevered firm. So this is a consequence of what we just saw. So the average investor, this is their required rate of return. So remember the players, right? Let me just go through this again. So we have the bondholder. I'm going to write it. That's our B to the bondholder, our S to the stockholder, okay, so I'm going to use the symbol RS for return to stockholder in the levered firm, and B for return to the bondholder, and then U as the return to stockholder in the unlevered firm. I probably should make this bigger. This is really important, or you're not going to be able to follow. So these are all the players. Bondholder, return, stockholder in the levered firm, the stockholder in the unlevered firm. And lastly, this guy or gal that is the average investor in the levered firm. You got that? There's 4 kinds of investors. Exclusively bondholder, exclusively stockholder in the levered firm. And then I guess this person would be, oh, maybe I'll put him up there. Or her. Them. Up here. Okay, so you have a person who's partly invested in stocks and partly in bonds in that same firm. And then you just have the stockholder in the unlevered firm. Is that all right? So there's like 4 things drifting, characters that we care about here. So this is the return to the average investor in the levered firm is equivalent to the return to the investor in the unlevered firm. That's the main point. So that's a main point. And then I expand that, where this is the WACC. So what I'm going to do now, because I'm just staring at this and I'm staring at this and I can see this, I want to isolate the return to stockholders in the levered firm. Okay, so what I'm going to do is equate the unlevered firm stockholders return with the WACC, which is basically what I did here, but I'm going to rearrange it here. So what do you see? I'm going to make it bigger. Let's do this. That didn't work. Let me do that again. So RU equals S over S plus B, RS plus. So what we're going to do is try and show the different perspectives. So rearranging this to solve for RS makes it, so I'm going to put RU minus B S plus B RB equals S over S plus B RS. Everybody okay with that? So I've just moved this over here. And then I'm going to cross multiply this up and put this down. It's probably a prettier way to do this, but that's what I'm going to do. And so this is going to become S plus B over S RU minus B over S plus B RB equals RS. Any questions so far? Should I start over? Are you with me? Can you see that? So I've taken this and moved it over here. So I subtracted that from both sides. And then I want to isolate RS, so I cross multiply this up. So I multiply by the reciprocal here to this side. Now, you see how this is going to work? I'm going to have S plus B RU minus BRB. So this gets distributed here. I'll leave the 1 over S there for now. You see where this is going? So you can take some time to review that, but you see what's going to happen next is that I'm going to expand. I better just finish it. I don't know, this looks really messy. Do you want me to do it again? No one's commenting. It looks messy to me. All right. So this will be SRU plus BRU minus BRB with an S in the front. And now I can group my terms because this S over here will cancel with the S down there, but there's still an S over here, so that goes there. So that is where the formula comes from. And what does it say? So what I've done is I found what RS is equal to. So the return to stockholders in the levered firm, in other words, the required rate of return, increases beyond the required rate of return in the unlevered firm. The higher the debt to equity, so the more debt relative to equity, it's going to increase basically. So stockholders demand a higher rate of return to take on debt holders. That's what it looks like. Now this term here, the return to equity in the unlevered firm minus return to debt, this will always be a positive because remember we take on debt at a lower rate than equity. So this should always be positive. Well, let me do it again, Daviana, because I think it's confusing, but okay. So let me review and then I'll do it again. So this is the formula. So now what I'm going to do is move this to that side. So that's this here. Now I'm going to cross multiply this term to all of this. That's what I do. So this goes in the bracket and I cross multiply. So when I cross multiply, I leave the S out here, but I distribute the S plus B here and here, but you see it canceled with this one on the bottom. So that's why I just have B. And then I distribute the S and the B to RU, and I group my terms. When I do that, I see that if I distribute the 1 over S, it'll cancel this, but it'll stay here. Yes, that's RS. All right, so I'll do it again. I'll do it one more time. I'm going to do it one more time because this just got so messy. Let me do it one more time. So we begin. I'll bring the formula over. Remember, I'm writing on glass. That's not always the easiest. I can't do much with that. Okay. No, I can't separate them now. All right. Fine. So, where did I start now? Oh, that's not the one. That's the result. That's the result I want. I want to get the original formula, sorry. So where I want to start is here. All right, now what I want to do is isolate S. So I begin by moving this term to the other side. Like that. Now I'm going to cross multiply, and I'll do it on the left side, on the right side. All right. So now this is all equal to RS. I'm going to distribute this term S plus B, which is V really. But I'm going to leave the 1 over RS for now. Then I'm going to distribute this among RU. So this is going to be SRU plus BRU minus BRB. And finally, I'm going to group together these terms. Divide by S. All right. So that gives you RU, because these cancel, plus BS RU minus RB, and all of this is RS. So where this is the return to shareholders in the levered firm, they demand a required rate of return that's higher than the return to the unlevered shareholders, the shareholders in the unlevered firm, the higher and higher debt to equity ratio, because this is a positive, it's always just going to go up. That will be positive because debt is issued at a lower rate than equity, right? It has a greater commitment from the firm. It has a commitment from the firm that the shareholders don't have. Okay? So that is where this formula comes from. If you need me to, I will show that again. All right, so cost of equity. So the cost of equity in the levered firm has two parts. RU, otherwise business risk. This is the risk inherent in the firm's operations, as captured by the beta of assets. And this part, which is the financial risk, the risk of taking on debt, okay? So as I explained, as this goes up, the required rate to investors that are shareholders in the levered firm will also increase. And this is illustrated here. So here we have cost of capital on this axis. So the other one was with the value of the firm on the vertical. And here we have the debt to equity ratio on the horizontal. And as it increases, there is no increase because of no default risk. Bondholders are not anticipating that greater debt will lead to default because we've removed that possibility, making an assumption there's no default risk. So this, no matter how much debt bondholders will require this level of return, it doesn't change. Similarly, the average investor in the firm, as we explained, they will have the same return as a return to the average investor. The average investor in the levered firm will have the same return or required rate of return as those in the unlevered firm because the value of the firms is the same no matter how much debt is issued. However, to balance things out, the required rate of return to shareholders in the levered firm must increase. Okay, so more and more debt issue, they want to be greater compensated per dollar invested, as otherwise they to compensate them to take on the additional risk, essentially, that they might not see any payoff because it'll go to the increasing debt. Okay, so bear with me. So that is stage one. We did proposition 1 and 2 with all those assumptions, and the biggest one being that there are no corporate taxes. Next, I'm going to allow for taxes. I'm going to introduce taxes but I'm going to maintain, for simplicity, a number of the assumptions we already made. And the big one here is that there is no risk of default still, okay? So we have, as a result of taxes, an interest tax shield. And let's see how that influences the firm value. Now the firm value will increase the more debt is issued, because there are going to be perpetual tax savings as a result of paying interest payments to bondholders and being able to reduce the taxable income. So we continue to assume perpetual cash flows, and you'll see how that plays into things. We assume we don't have to deal with any kind of depreciation or, how we worked with capital budgeting and included tax shields from depreciation. So we're just going to throw that out. That's not happening. We're not going to deal with that. And we're not going to deal with net working capital spending or a fixed asset purchase. Nothing like that. Nothing capital budgeting. We're going to leave it out. Making this simple. And what do you see? Here is a firm considering going from zero debt to $400 of debt issued at 10%. So the unlevered firm, we're going to continue with the assumption that earnings will be identical in the firms. These are strong assumptions to force our results, just to let you know. But it's part of the theory. So in the unlevered firm, there's no debt, so there are no interest payments to bondholders. In the levered firm, there is debt, so there's going to be 10% of the $400 paid out to bondholders, and this is each year, right? This is each period. I'm looking at this income statement. Now, taxes will be 40% of 200. Or $80. For the levered firm, taxes will be 40% of 160, because the interest payments are tax deductible. So taxes are lower for the levered firm. How does this play out? So the net income here is 96, and the net income here is 120. So that does look like, this is still higher, but no, there's a tax shield here of $16 that needs to go in our cash flow analysis. Okay. So cash flow from assets, earnings before interest and taxes minus taxes would be 120 here, but earnings before interest and taxes would be 136 here. So this $16, where does it come from? It comes from this calculation. I mean, obviously it comes from me taking the difference here, but in general, I could calculate that. Remember, for the capital budgeting exercise, we used TC times D. In this case, it's just going to be however much we claimed. This is the claim. This is the general rule. This is how it works. So whatever you claim times the tax rate, that is the amount of tax savings you'll experience. Any questions? Just filling this in. So this expression here, TC times the claim, that's just for one period. What about perpetually? So this would be $16 in our example indefinitely. So this is just the perpetuity formula. So look at this. This is what I had on the other page, but now in general. And then I divide by the rate, which in general was RB. So this gives me this amount. Okay, so this looks like the TCD that we had before. So what does this do? So perpetually speaking, remember that value is the present value of future cash flows. So this is the future cash flow the present value of future cash flows. This is the present value of perpetual tax savings. So this gets added to the value of the unlevered firm. So this is known as M&M Proposition 1 with taxes. So it looks like adding more debt adds greater value. How much more debt? Is there a limit? What's the goal of the shareholder again? To increase the value of the firm. So shareholders will do what? They will want more and more debt. So it looks like, going back to our illustration with debt on this axis and the value of the firm here, where we initially talked about Proposition 1 with no taxes and all those other assumptions, then it doesn't matter if the firm issues debt, the value doesn't change. Once we introduce taxes, there's a tax shield that incentivizes debt. In fact, this is unbounded. It looks like the firm should be completely financed with debt. So if you think these results are strange, that's okay. Then you're right. They are. These are a number of assumptions to force these results, okay? But you're going to see in the correction, the next scenario that I'm going to present, it's going to be more realistic. We had to lay out first what are the extreme cases. So you're following so far? No taxes, flat. Taxes, there's an incentive for investors or shareholders to like debt because that increases the value of the firm through this term here. So now we got to look at Proposition 2. What happens to the rate of return to the stakeholders in the firm? So let me take this with me. So first I'm going to present an example. No, that didn't work. That didn't work the way I wanted. Okay, just let's look at an example, an exercise, and then we'll talk about Proposition 2 and what happens to how do we see the required rates of return, or the rates required by the investors in the firm, the stakeholders in the firm. All right. Any questions so far? So what I'm going to do is let you look at this for 5 minutes and see if you can make any sense before I solve it. So look at that, get a glass of water, get a snack, and I'll check back in 5 minutes. Okay, how did you do without me? So here are the details. The firm's earnings before interest, so these are cash flow from assets, right? Sorry. Okay. So imagine that debt goes from $0 to $100 at 10%. So this is our B. What happens to the equity value S? So we take the earnings times 1 minus TC and the value of the firm. So this is maybe looks new, but remember the value is equal to the present value of future cash flow. So this is going to be the perpetual future cash flows after tax. And then the discount rate is 12.5%. So that's going to be the required rate of return to investors in the unlevered firm. That was figured out by using CAPM or whatever it was. So the unlevered firm value is $560. Now the levered firm. How do we determine the value of the levered firm? Well, we learned here that the value should be determined this way. I'll do it again. So I'm not inventing this. This is what we just discussed. All right. So we're going to take the value of the unlevered firm, 560, and add TC, which is 0.3 times B, which was 100. In this formula, we sorted out already that this is the present value of future cash flows. So that's going to be $580. So there's your difference. The value of the firm with debt goes up over the value of the unlevered firm. Now, what is the shareholder equity? Shareholder equity would be the difference between the value and the debt. So it went to 480. How many of you got that? All right. So that is an example demonstrating this graph. Ready for the next part? So now we got to look at what does it do to the different stakeholders in the firm. Remembering there are 4. There is the, let me do it again here. Doesn't hurt to repeat myself. There is the average investor. So we have to think of the return to average investor in the levered firm gets WACC, the weighted average cost of capital. Then there's the return to the bondholder in the levered firm, and they get RB, and the stockholder in the levered firm. And they get RS. And this is for the levered firm. For the unlevered firm, we have just the stockholder. And we denote their return as RU. Okay, so four classes of investors to consider. Now, we have to reintroduce taxes. And when we introduce taxes, the algebra gives you this. I'm not going to do it again. But it gives you this. So what does this say? It says when we relax the assumption and allow for taxes, that the return to the investor in the levered firm, that's a stockholder, continues to be determined as it increases the more debt relative to equity is issued. That's basically the point. This is just adjustment for the fact that there is taxes. Remember the 1 minus TC, the nature of this statement. Because per dollar invested, this is what the firm pays out, and this is what, in turn, the bondholder requires. So using the results from the last, or the details of the last problem, can we find the return to stockholders in the levered firm and the return to the average investor in the levered firm? Because we need this for the WACC, you see. Note that the WACC is not equal to the return to the investor in the unlevered firm anymore. This is going to change. Okay, so initially they were the same, but they're going to change. So actually this formula here is based on the last proposition, and I just added in taxes. You wouldn't be able to solve it in the same way because these aren't equal. So this is a result from the last algebraic manipulation to get RS, and I just added in this term here for taxes. So let's use these details here let's apply them to get this RS. So RU, which is 12%, 12.5, plus 0.125 minus RB. RB was 10%. That's what this means. Okay. So this is minus RB times debt was 100 and equity in the levered firm, we figured it out. So debt was 100 and equity was 480. So let me write that down too. You see, we need all those numbers. Let me write that better. Okay. So then this is going to be 480. And then 1 minus 0.3. There you go. So calculate that. Let me know what you get. How you doing? I get 0.128645833, and I'm going to store it just in case I need it in 1. All right, so that is the return to shareholders, the required rate of return to shareholders in the levered firm. We had to get the S of the levered firm to calculate that. We knew the B, we knew everything. We just needed to get this. So we already got it, so that's good. Next, the WACC. Since RS is increasing now, WACC will increase too. So it's not going to be the same as RU. So this has increased, or this is, we're going to use this number in here to get the WACC. I guess the question to ask is it going to be higher or lower? Is WACC higher or lower than RS? What do you think? I'm just going to recall one here. So these are the sorts of calculations you're going to make. It's not difficult. It's just you need to know which formulas and when to use them. But it's really not difficult. So you could store each of these and add them together. I get 0.118534448. So it is going to change. It went from 12.5%, RS goes up, and WACC looks like it's going down. Where's WACC ultimately going? So RS is up, WACC is down, because remember, it's a weighted average. So you see where it's going. Let me make a comment first, and then I'll show you the graph. The WACC decreases as more debt financing is used. Since WACC is a discount rate for future cash flows, the optimal capital structure is all debt. So WACC in the limit, because there's going to be all debt, so it's going to be 100% debt eventually, theoretically, WACC must just be this. The average investor in the firm becomes a bondholder. So WACC approaches the rate of return to bondholders. RS just goes up, RU is flat. This is with the debt to equity ratio on that axis and cost of capital on that axis. All right, we are at 10:30 and I'm going to show the last scenario. I'm going to relax some of the strict assumptions and now allow for default risk. So very much more realistic. So more and more debt would make bondholders concerned, as well as stockholders or prospective stockholders and bondholders, and they would require an increasingly higher rate of return. What does that do to firm value? What happens to the firm value? The fact is that with taxes, debt provides tax benefit to the firm, and the firm should borrow an infinite amount. or a the capital structure should be all debt. In reality, the firm has to pay interest and principal to bondholders. If the firm defaults on a payment to its bondholders, it will enter a phase of financial distress. Or, ultimately, if financial distress persists, the firm will declare bankruptcy. There are costs involved in both financial distress and bankruptcy. There are direct costs of financial distress, the legal and administrative costs for lawyers and accountants and expert witnesses. But there's also the indirect cost to consider, the impaired ability to conduct business, so lost sales. There are also agency costs, because in financial distress, stockholders may engage in selfish strategies. They may have an incentive to take large risks, right? Because they imagine, let's just try, what do we have to lose since we might go into bankruptcy? Let's take large risks. And that's not always wise because they're risky. Selfish strategy too is an incentive towards underinvestment. So they'll take large risks, but they won't take positive NPV projects on. And this is, again, the stockholders are the owners, and they will reward the board of directors for their choice of managers that satisfy those their selfish strategies. There's also selfish strategy 3, known as milking the property. So they have an incentive to liquidate dividends, or selling off parts of the firm and then paying that to shareholders as dividends. And this, in compensation, managers will pay themselves as well with perks. So they'll get bonuses. You heard about the global financial crisis in 2008, and it was unprecedented, the bonuses that managers were getting as firms were closing operations or trimming down. So this is managers being rewarded by rewarding shareholders, or paying or liquidating assets to pay dividends to shareholders. So these are all going to adversely impact the value of the firm, all of this. So although we have that debt adds to the value of the firm because of this the present value of perpetual tax savings, at some point debt will take away from the value of the firm because of these added expenses. So for firms with a low financial leverage, the probability of default is close to zero. So this amount here that we would have to adjust for, this would just be zero, and we're back to looking at the benefit of debt, right? And so this would be zero. But what if a firm is highly levered? At some point, this will kick in, and this will be positive. So that will take away from the firm value. A dollar increase in debt will increase tax benefits at a constant rate TC, but also increase costs of financial distress at increasing rates. So, in conclusion, we would increase debt as long as tax benefits exceed the present value of the costs of financial distress. That allows us to find, you see this is a lot of arrows and things, but you already saw this graph with firm value not being affected by debt because of no taxes. Then we saw this when we introduced taxes but no default risk. But in this more realistic scenario, at some point, the firm value will be adversely affected by increasing amounts of debt. So this is actual firm value of what we just did here. Okay? All right. What happens to the average investors? Remember those people and the other stakeholders. So let's take this over again. Remember all our players. There, we have to consider the return to the average investor in the levered firm, the bondholders in the levered firm, and the stockholders, like purely bondholders or purely stockholders. And then we want to see what happens to them. So what we have here, remember how things looked up until around here, right? We said the return to stockholders in the levered firm the required rate of return would increase the more debt there is. The WACC would decrease to look more and more like the return to bondholders, because they would become bondholders, right? The average investor would become a bondholder because the capital structure would be all debt. But at some point, things will turn, there will be concern of default risk. There'll be concern of default and then bankruptcy, financial distress and bankruptcy. And in that case, the bondholder will require a higher rate of return because they are not even secured that investing in this firm is going to guarantee them their return. So they're going to ask to take that additional risk. They'll ask for a higher rate of return. And so that'll affect WACC and that will go up. All right, so that's what's going on here. What we want to determine is, where does this change happen? Because that will give us the optimal leverage ratio. And I see it here too. So if I can define a function for the value of the firm, I can use mathematical techniques to find out what is the optimal level of debt. And we can use calculus to do that. So what I want to do is some of the exercises. We have an hour, so let's look at some of the exercises I gave you. Do you have any questions? What happens here is that I'm adding a cost. So to make this go up, I'm just speaking about it in general, a premium for the cost of financial distress. So if I ever asked you to calculate something like this, I would just give you this value to add in so that you show me, you demonstrate that you understand that this is augmented, that the WACC is augmented by this amount. And in terms of the return to shareholders in the levered firm, I don't change my formula for that. That just remains an increasing formula. So this is the thing that changed, and this one. So are there any questions? You guys get it in principle, what I'm talking about. So 3 scenarios, beginning with the most abstract, showing that the firm value is not affected by issuing debt. Then I relax the assumption and allow for taxes, and immediately we see that debt should be the capital structure of the firm. It should just be an all debt firm, and that will indeterminately increase the value of the firm. And then I say, okay, now take away the risk, take away the no default risk assumption, so allow for default risk, and now we say at some point the firm has to taper issuing debt, or else they're going to lose value. And we want to find this optimal level of debt. All right, so let's see. I gave you a number of exercises and solutions. Did I put them in here? Hang on, let me. Okay, so I gave you the notes. So the calculation that we did together is repeated in the first review. In the second review, I step through, I guess we can do that one. In the third review, okay. Okay, let's look at the third review, question 3. That's not what I wanted. Okay. Assume the M&M model with corporate taxes and financial distress holds, and that the CAPM is true. Protect Core is a corporation financed with debt and equity. 800 million of its assets are financed by debt, paying an effective annual return of 7%, and the remainder with equity. PCI's earnings are subject to corporate taxes at a rate of 40%. A financial analyst has estimated that if PCI were all equity, it would have a market value of $500 million, and that the return on investment in PCI's equity would be 18%. The financial analyst believes that there are costs of financial distress associated with debt, and she estimates the present value of these costs to be either one of the following. So these are functions for the cost, the present value cost of financial distress. Calculate the market value of TCI under its leveraged capital structure in either case. So we need to take the function and estimate the market value. So what that means, so I'll move this question away for now, the optimal debt question. Okay, let's do A together. So the present value, so we know that the value, oops, oh, but I forgot to fix that. The value of a levered firm is equal to the value of the unlevered firm plus this, the perpetual tax savings from issuing debt. Now I have to minus this amount. So let's look at the information, see what we have here. We're told that the value of the unlevered firm if it was all equity, see, it would have a value of 500 million. So that would be 500 million. And then what's TC? TC is tax rate of 40%. And the debt issue that they're looking at is 80 million. At 7%. And then I'm going to plug this in here. This is 80, and I'm going to assume that that 30, well, we'll find out. Oh, it says both B and PV are represented in millions of dollars in this function. Okay, so this is also in millions. So this is all those numbers are in millions. Yeah. Okay. So what do you get? What is the value of the levered firm? So the M, because the M is everywhere, we just ignore it. What do you get? Should I plug it in for you? So let's see. Let's put that in the calculator. I'm going to enter from the exponent 30 divided by, sorry. 80 divided by 30. That's the exponent, and then second E. And then I'm going to put a negative in front and add that to brackets 0.4 times 80 bracket plus 500. That's the answer, $517.61 million. Let's try the other one. So this is A. I guess it should be 1 and 2, but okay. And what about I'm just going to erase it. So let's try the second one. The value of the levered firm would be value of the unlevered plus TCB minus 2 log B. So that would be equal to 500 million again, plus 0.480 million again. Okay, I don't even have to put the M. And minus 2 log of B, and B was 80 million. So with the second formula, I'm going to calculate I'm going to start with log of 80 times 2 negative plus bracket 0.4 times 80 close bracket plus 500. So it's 523.24 million. So this is 523.24 million. Hold on. All right, so these are two different functional forms. Let's notice something here. This is always increasing. This is a line. Now this is minus this function. What is the E function? What does the E function do? And then this one is the same sort of thing. It's a line and then minus this function. What does the log function do? What does it look like? Remember, we are looking for this. If there's an optimal level of debt, it has to go down after the line. It's going to go up for a while, but then this kicks in. So looking at the functional forms, maybe you know you're not expert at it, but you should realize that, okay, what's the relationship between E and log? The exponential function is never negative. It's always like that. And the log function is, well, it's never, let's say, the y is never negative. The log function, the x that goes into the log is never negative. So these functions are actually, that's not very good drawing. They're inverse functions to each other, where they are mirrored by the number line. The identity line. Why am I showing you this? So this is E. It's just a sketch, but this is E, and this is log. And this is an increasing function. If I subtract an increasing function, then the other function will go eventually down. So that's why this one will take the shape that I'm looking for. This one will take a curved shape like that. And I might be able to find an optimal level of debt. But the other one, I'm going to be subtracting a function that's increasing, but then it flattens. It's not all increasing. This just flattens out. Or this one goes up. So what happens is that it turns out that this one is going to be doing this shape, but this one is not, I believe. I'll just double check. Oh, yeah. So this actually has the opposite curve. This is called a concave function. But this one will have this shape. It will be convex. Now you should know that, but you will find it out if you did, even if you didn't draw it, you would find it out. In this one, you'll be able to use calculus to find where B is optimal, but in this one, it looks like the more and more debt issued, the value of the firm just goes up. So the optimum debt is all debt again. This would not give us the same result as this. So financial distress here doesn't really tamper things off. Things still explode. So the value of the firm increases. So if you want to increase the value of the firm, if you want the best value or the highest value, you just have an all debt firm. I say infinite, but I'll just write all debt instead. Okay, I don't expect you to perform calculus just because I didn't have time to review it with you and I don't know how good you are at calculus. So it's not hard, but if you don't know it, you don't know it, right? How many of you know calculus? That would be nice if you could tell me, but not many of you are here. So basically, you should be able to read this through and understand it, but in terms of calculating and performing the operations, I'm not going to expect much more than just part A. Okay? So you should be able to plug this into the formula and get some answers for part A. Part B, finding optimal debt. I'll say review this. I will put a bonus question on the test. For those who do know calculus and want to apply and impress me, apply their skill, okay? That's how I'll deal with that. So shall we do this together? Or shall I answer? No, I'm going to answer some other questions. Well, no, I should do this. I have time. I have an hour. So I'm going to do the next part, and then I'm going to go back a bit and do some of the other exercises. So let's see. I'm going to take this form of the function and work with it. So I want to find the optimal level of debt. I take the first derivative of this function. Wait, I have to go and get my, I need to get my numbers right. So remember, it's 500 million for the unlevered firm value and TC. I leave the B, the B's are my choice variable, so I don't fill that in. So before I do this, I'm going to make the general form of the function like this. So that's the function, and now it's a function of B. So what I need to do is I'm going to take the first derivative and set it to 0 and solve for B. Because why? Because that will give me the optimal level of debt. That's because the derivative is the slope of the curve where the slope is 0, the peak is reached. So if it goes like this, the slope of the curve right here Okay, I'm connected again. So all I did was prepare my stuff. Okay, so this is the value of the firm that's levered. And this is with the information I have. I know the unlevered firm, I know the tax rate. I'm leaving B as a choice variable, so this is my function. What I have to do is set the first derivative to 0 and solve for B star. Remember, the derivative is the slope of the curve, and where the slope is 0, the peak is reached. So that's why I'm doing this. So how do I take the derivative of this? The derivative of this function is, well, this is just a constant. The constant goes to 0. So let's see. I don't know how much you guys know about calculus really, but you should know it. So derivative of a constant. I gave you a formula sheet. So it's just a summary of the formulas. I'm not going to do anything too fancy. But here is some reminders. So the rules are, if you have a function that's a constant. So that will look like just a flat line. So what's the derivative of a flat line? The derivative will just be 0. Okay? In other words, what's the slope of a flat line? It's just 0. So that's why the slope of a constant, sorry, the derivative of a constant is 0. What about a linear function? When you take the derivative of a linear function, the part that's the constant, that will have a 0 derivative, but then this part, well, if you have a line, this part will have, I just take derivatives in the sum, the parts, and so this would be 0, but then this, well, the derivative is the slope of the curve, and the slope of the curve everywhere is b, so that will be the derivative. So you guys okay so far? So people who don't remember, this is your review. And then we have different functions and how to deal with them. In particular, the derivative of the exponential function. The derivative of the exponential function is just itself. The exponential function is such a way that the slope at any point of the exponential function is so the derivative of the exponential function, oh my goodness, let me write that again. So at any point, the slope of the exponential function is just itself, e to the x. It replicates itself. The derivative replicates itself. So that's what we need. So there's all these other things here. You know, I made it a little bit, but anyway, what you got to do if there's something connected to the exponential function, it's still just itself. However, if you have a function in the exponent, you have to take the derivative of that function as well. That's applying the chain rule. The chain rule, which is defined back here, or up here. When you take the derivative of a function with a function inside of it, you go step by step. See, here's a function with a function inside. So you have to take the derivative of the outside first, and then the derivative of the inside, and you multiply them. So that's the example. So the last one I'm going to show you right now that you really need is the power function. If you have a function that is not exponential, but it's a power function, like x to the something, rather than e to the x, it's x to the power of something, a constant, then the rule is this: it loses 1 degree of power. So this is like saying, I'm just going to make one more drawing. So we're going to go, we started with a constant, I made a line, and now I'm going to make a curve. So So this curve this is a parabola. Could have a form like this. And at every point along this, the slope increases. So the derivative of this actually turns into a line. The A becomes 0, the B becomes B, plus this becomes 2cx. You see, what happened is that I lose this square power. It comes in front, so the power reduces. So it turns the function that is a curve, its derivative becomes a line. So this is a line. I'm going to reduce that. That's equal to b plus 2cx, which is just a line. So it goes down. So if you have a cube function, the cube function becomes a parabola. The parabola becomes a line. The line becomes a flat line with no slope. So I should say that again. So a cube function becomes a square function. A square function becomes a line that with a slope becomes a flat line or constant. So it goes down in degrees, all right? And that's captured in this function here. So for instance, like the one I did, whatever number is there, it gets multiplied and the power goes down to 1. So if I give another example, if y or if fx is equal to x to the power 3, then the derivative is, the 3 comes down and it becomes reduced by 1. Alright, so that's all I'm going to say about that. That's just to remind you how to do this. So let's take the derivative here. The derivative of a constant is 0. The derivative of a, this is like a slope, right? This is a slope on a line. This is going to give me 0.4. And then this gives me b over 30 back. But I have to take the derivative of this part and multiply it. So this becomes 1 over 30. So I can rewrite that as 0.4 minus EB30 divided by 30. And now I set that equal to 0. And I try and find where the optimal debt is. And then this will be 0.4 equals e to the b30 over 30. Yes, Danielle, he's right. It's going to be a bonus question on the final. And it'll be optional on the test. So solving remembering these are millions of dollars, the answer is 74.55 million. That's what I get. I feel like I did something wrong. Did I do something wrong? Let me see. I did. No, that's right. So now we have to do two things. I found the optimal level of debt using calculus. Now I want to find the optimal value of the firm. But first, let's confirm that this is a maximum. How do I confirm that this is a maximum? Unless I draw the curve or put it in Excel or something. What I do is I check the second derivative. In the notes that I gave you on calculus, I explain, or I summarize here. Oh, the curve got mixed up again. Why does it do that to me? I wonder if yours got distorted. Why does it do that? I was pretty sure I sent you a good one. See this one? Nope, that got distorted too. That's not it. All right. So what you have what we've done is this. The first derivative is 0 when the slope is 0, right? Because the derivative is the slope. So it could be that we have a maximum, but it also could be that we have a minimum. So we have to verify it's this situation that we have. And the way we figure that out is we take the second derivative. The second derivative, if it's less than 0, then that's a negative, and that will work. That will be a maximum when the second derivative is negative. And the way you always remember that is you have a negative face, a negative, no, right? It's a negative, unhappy face. gives you an optimum. And the way you remember that you get a minimum if the second derivative is greater than 0, it gives you a smiley face, positive if it's a minimum. Okay, so you check the second derivative, that's the rule, and I'll resend this document for your record. So let's check the second derivative. It means I take VL prime prime let me do that again. I'm going to write down first the derivative function, which would be FL, the derivative like that. Now this part is just a constant, so that's 0. And then this part, it's itself, but then I have to multiply this by the derivative of here according to the chain rule. So this becomes and this is always negative because the exponential function is always positive. If with a negative in front, this is always negative. So happily, this is a maximum. So the last thing to do is to figure out the value of the firm with this optimal level of debt. So I can call it the optimal value of the firm. Is where the function is at B star. The original function remember is 500. Everything's in millions of dollars. 0.4, and I put in this value 74.55. And then minus E, and I put 74.55 divided by 30, and I calculate the value of the firm. Now notice the optimal level was 74 million, and we talked about 80 million before, right? So we just overshot 80 million. So by using 74 million in here, we're going to have an optimal level of the firm, or value of the firm, that will exceed the one we already calculated. So when you put this all together, you should get very close to the other answer, 518 million. So that's the best the firm can do. All right, so as I said, for the test, I will have this stuff I talked about as an option, so that students that want to study everything will have the incentive to study everything, and they'll also get rewarded for studying everything. So this will be an optional question. In the final, I will keep the calculus part as bonus. All right? So for people who already know calculus, they should be rewarded. And those who still, either haven't taken or didn't learn or whatever the case, I think this is a great opportunity for you to learn it. I think it's very straightforward. I'm not going to do anything too crazy. But if you're running short on time, I'm not going to penalize you. All right? So you have several answer keys. There'll be several answer keys. You have several answer keys to review. And just let me know if you have any questions. Okay, you're going to have to study a lot today before tomorrow. I'm going to post the test in the morning. And I should be grading I should get you the grades of the first, second tests soon. I'll work on that today. I have 2 big things to do today, and I will make that one of them. So you sort of know what you're going into the test with. So do you have any other questions for me? I've given you a lot of material. But this is the material for the course. We fit it all into 3 weeks, and I know it's a challenge, but it's over. That's the bonus. That's the benefit. It's over in 3 weeks. So we agreed the test will be Monday morning from 9 till noon, and I will put it in Connect. And the test, admittedly, the final exam will be pretty basic compared to what I'm doing here. It's just an overview to make sure you walked away from this course with the main concepts. The test, on the other hand, will be more it'll be more calculations, more like the notes I've given you. Okay? So if you don't have any questions, just get to work and keep me posted. I will be available today if you have any questions, you want to meet with me, or you just want to ask me something, okay? You can text me, call me. I think texting, and then we'll arrange for a call. That will be the best. So it's up to you if you want to invest the time to learn the calculus. If you do not, and I get it, if some students don't, they remember the calculus, this should be not a big deal to just review briefly. Also, for those who have learned calculus, this is showing you, a direct application. It has a lot of value to learn that you can apply what you learned. This is very important in financial analysis, in corporate finance particularly. So if you don't have any comments or questions, take a deep breath, take several deep breaths, and study steadily today and the weekend. I know as you write your test, you'll be preparing for your final, so you won't be wasting any time. Okay? You can contact me on the weekend too. Otherwise, I'm going to say goodbye, and it was a pleasure meeting you, even if it's virtual. And come and say hi next semester if we happen to be in classes. So I'm going to sign off. Take care. Cuídense.